Hey guys, today I'm going to start. Today marks the first episode of what I'm going to start calling Technical Tip Tuesday, and the purpose of these videos is just going to provide um, different explanations of charting techniques, indicators, and patterns that I like to use with my trades, and hopefully answer a lot of the commonly asked questions I get asked on Twitter and on the stream, and today's first video is going to be, it's going to cover the RSI, and I'm going to go over common uses for the RSI, how valid is the RSI, and different applications of using the RSI to enter and exit trades. So just on a high level, the RSI stands for Relative Strength Index. So RSI stands for Relative Strength Index. And the RSI it's an oscillator. It gives you the health of the market. It tells you if the market's overbought, if it's oversold. It tells you, it gives you information about the momentum of a move. Is the momentum slowing? Is the momentum growing? Is this move in a given direction? Say, if the price is moving up, is this trend likely to continue? Is it likely to flatten out? And is it likely to reverse? The RSI contains all this information. But before we go into it, I think it's important to note that no indicator should be used alone. We should think of ourselves in the market as investigators, and each indicator that we use is going to be just one tool in our toolbox. It's going to be one piece of evidence to form an argument for why we should be entering or exiting a position in a given direction. And RSI is a great, for those that are new to trading, the RSI is a really great tool. It's very easy to use if you know what you're looking at, and a lot of information can be extrapolated from just the RSI alone. One of the most basic uses for RSI is using it to measure if a market is overbought or oversold. So if a market is oversold, that means that the price has gone too low, and that means that the sellers are starting to exhaust. They're starting to taper out, and now buyers are going to step in. And vice versa, if a market is overbought, that means that the buyers are starting to slow down, and then the sellers are going to start picking up. So you can think about it like this. You can think about it like a man pushing a boulder up a hill, right? So if he's pushing a boulder up a hill and the slope is like this, it's going to be relatively easy, and you can push it higher and higher and higher with the same level of effort. But if the hill is something like this, then as he pushes it higher, it becomes harder and harder because the slope increases, and eventually it's likely to reverse and roll back down the hill. So you can think of the market the same way, right? The price goes up, the price goes down, and we can use the RSI to judge whether it's likely to roll back down the hill, so to speak. So let's go over a couple of examples of RSI and different applications of the RSI. So if we're looking at the 6-hour chart here for Ether, this is going to be ETHUSD on Bitfinex. So for those of you that recall, there was a bear market a few months ago that bottomed out at 136, and it rallied for a couple months and topped out at 395. So if we're looking at the 6-hour candles, we see we made one high, two highs. You could say maybe 3 highs here, but we won't count that. And then here's the third high right here. So 1, 2, 3. Typically with the RSI, what we want to see is as the price makes a new high, the RSI should make a new high as well. So, just a basic trend, say it's going up like this, the RSI should be making new highs as well. So as we see a new high, the RSI is making a new high. It doesn't have to be this linear fashion, but we want to look at the peaks. So here's 1, here's 2, here's 3. If we project downward and go to the RSI, we should see 1, check, okay, made a new high. 2, check, made a new high. But then when it comes down to 3, come down here, 3 does not make a new high. Okay, so what does this mean? That means that we're approaching the part of the hill as we're pushing the boulder up the hill that is starting to get heavier and heavier. The market's becoming heavier and heavier on the buyers, and it's likely to turn back around. And sure enough, that's what it does right here before it goes back down. So we see 1, 1, made a new high, 2, 2, made a new high, 3, 3 is not a new high. You can see it here, it's starting to trend downward as the price trends upward. And the level of effort to keep the market trending upward is it's becoming heavier and heavier on the buyers, and it's likely to turn around. So it's important to note that the RSI does not tell you that the market is going to reverse. It doesn't tell you that it's going to consolidate. All it tells you is that it is likely to reverse, or it's likely to consolidate, or it's likely to go flat, right? So a market can diverge indefinitely. Okay, you shouldn't look at your first sign of divergence and say, okay, time to bail on my position, or time to start shorting if we're in a bull market. That's not what that means. All it tells you is that at the current trend that we're seeing here, the market is becoming a heavy burden on the buyers. That doesn't mean that the market is going to reverse. All this says is that, hey, it's time to start looking at the market, start looking closer, and start planning a potential exit if you're in a long position here, or if you're looking to go short, start planning a potential entry into a short position. So let's look at another example here. Let's look at the bear run from 395 to 198. So we see this is very clearly a bear run here. We see new lows being made. We don't see new highs being made, and the market's kind of it's obviously trending downward. When we're in a bull market, we want to use the tops of the RSI, and vice versa. When we're in a bear market, we want to use the bottoms of the RSI. As the market's trending downward, we want to see the RSI making new lows as well. So same methodology here. Let's go. Here's dip number 1, and here's dip number 2. Okay, we go down here. Here's dip number 1. And what we want to see if we're in a short position, we want to see a new low being made here. And sure enough, it doesn't. Okay. So this sort of price activity, as the market makes a new low, but the RSI does not make a new low, this is called bullish divergence. Bullish divergence. Okay. And so when we see price activity like this, it's usually time to start planning an exit of our short positions and maybe start looking for a long position, because the market's pushing new lows, great new lows actually, but the RSI is struggling to make new lows, and it's showing that the momentum of this move downward is starting to die out. Okay, let's look at another example. So it's important to note also with the RSI that these techniques, they also apply on very high time scales, and they apply on very low time scales. The only thing that's going to change is the level of effect on the market. So if you have something diverging on the 15-minute, that doesn't mean all of a sudden it's going to go into this macro bear market. That's not what that means. All it means is relative to that 15-minute trend, it's likely to reverse or go flat, or not likely to make new highs. And if it's a macro trend, like something like the 12-hour, for example, like what we're about to look at here, the 12-hour, this is something more macro for the market, and it's time to start planning an exit of our long positions here. So here's another example. So we made 1, 2, 3, 4 new highs on this run from the 50s to the 412, right? So 1, 2, 3, 4. And when we go to our RSI, we want to see 1, 2, 3, 4. So here's a great example of when the market was diverging heavily, yet it made a new high. So here's 1, 2, so made a new high here. However, on point 3, it makes a new low. So here's a great example of when the price makes a new high, but the market, but the RSI does not make a new high, yet the market continues upward. And so you can see here, as the price is making new highs here, though, the RSI is failing to make new highs, and it's losing a lot of momentum, and it's time to start exiting our long positions and start looking to either go short or just go into fiat, but it's very clearly diverging this whole length of the way here. So it's time to start looking heavily at the market, start looking closer, and look for signs that maybe it's time to get out of a position, because this divergence is blatant here. So again, this sort of price activity, as the price is making new highs here, but the RSI is not making new highs here, this is called bearish divergence. Okay, so let's go ahead and recap what we went over. So the RSI is an oscillator that measures the relative strength of the current market relative to the previous market. It tells you if it's overbought, if the trend is likely to reverse, if it's losing momentum, and it'll give us a really good indication if we should be looking for an exit of our positions. The RSI can take a couple extra forms. It gives us a little bit more information than what we went over in this video. So it's important to note that there is actually more information to derive from the RSI, but on a basic level, it's just going to tell us this, right? So if the price is making a new high, but the RSI is not making a new high, this is called bearish divergence. And as the price makes a new low and the RSI does not make a new low, this is called bullish divergence. Okay, so it's just giving us an indication of the strength of the current trend. So that wraps up Technical Tip Tuesday. If you liked what you heard and you found it useful, feel free to drop me a like on YouTube. Share it with your friends. And if you want more information outside of the Technical Tip Tuesdays and you'd like to join the Discord network, those links are available in the description below. And yeah, as always, thanks for your support, and I'll see you next Tuesday.